We're a little bit early, but I guess I'll just start right ahead. We have a lot of charts, a lot of good information for you guys, and it's towards the end of a long day. I'm sure you've heard of a lot of information for now, but maybe we can top it off with some really good charts and some really good discussion. So thank you for coming to my presentation. For those of you who don't know me, my name is Omar Ayales. I'm Chief Trading Strategist for Gold Charts for Us, a weekly trading service started over 20 years ago. So we basically are, what I'm here to do today basically is to explain to you, things that you already know, kind of like how we got here, okay, on my take on that, and where do we go from here? Where is the world right now, and what are the what's the investment landscape looking like? Basically, as many of you know, inflation has been, running rampant, and has caught everybody a little bit by surprise, especially in 2022. Not because people were not expecting an inflation run. I think everybody, in a way or another, was expecting it. I think it's been stronger than many anticipated, and the reality is that this inflation story has been the strongest one in over 40 years. And why is that important? And, basically the last time I was here was 3 years ago, and I haven't been able to be here since because of, the COVID restrictions and traveling. I'm originally from Costa Rica, in case you notice the accent. But why is this important? Back in that presentation 3 years ago, I told everybody the single most relevant macroeconomic development of 2019 back then was gold's breakout rise above 1365. What is what was 2022 most relevant situation? And basically that was, if you're looking at U.S. treasuries, which basically are, the largest bond market out there, okay, you see the 30-year yield, which is long-term bonds, which is in theory a market that is not manipulated as much or can't be manipulated as much by, the Federal Reserve, since it's a large market and trades, trillions of dollars. But basically, if you see, last time we had a big inflation rise it peaked in 1981. And many of you know that, but that's over 40 years ago. Most of the analysts that you've been listening today, including myself, weren't even trading back then, weren't investing, probably weren't even born. Why is this important? Back then, when interest rates peaked, we started basically a bear market in interest rates or a bull market in bonds. It's a market that has lasted for 40 years, okay? The bond market, especially in U.S. Treasuries, tends to move in secular periods of 30, 40 years. So in 1981, when inflation peaked and interest rates peaked, they started to decline. And you see this chart, my first chart basically is since 1978, shows the peak of the interest of the 30-year yield, and then how it has been declining ever since consistently. You'll notice that the red line is an 80-month moving average that we basically have tracked over a long period of time, and you see how basically the trend has been consistent below that 80-month moving average. 2022, of course, the Fed starts raising rates, interest rates across the curve starts to rise, and basically interest rates for the first time in over 40 years break out above this moving average. So what does this mean? Basically, this means that the secular bull market in bonds or bear market in yields is over. After 40 years, it's over. This means that it's very likely that for the next secular market is going to be a bear market for bonds, a bull market for interest rates. This means higher rates for longer. This means probably that inflation will stay stickier than what most people think. This doesn't necessarily mean that the U.S. economy or the global economy is going to be, the U.S. economy is going to be super strong and also leading basically the demand for resources globally like it did in 2022. But it does mean that the new normal is about higher rates. How do we get there? Well, and before we actually go into the reasoning for that, this other chart basically confirms the previous chart. And it's interesting because, gold and bonds have had a very interesting relationship over the past 20 plus years. Back in 2002 or 2001 when gold bottomed in the secular bull market of gold, it started moving together with bonds. In that segment of the bull market in bonds, gold and bonds have been moving together for over 20 years. Just in 2022, when the bond market collapsed, it decoupled from gold. So you see, for example, in this chart, basically gold fell below, or just basically fell to the March to 2021 lows this past year, while the Treasury market broke below the February lows, which would have been the same lows as gold. This decoupling of a 20-plus year relationship tells me is a symptom of that the actual trend, the secular trend in bonds, has changed. Now, as you all well know, you hear people talking about, well, but the inflation story is that inflation has been coming down. What are you talking about? What are you talking about that inflation is going to stay stronger? Everybody's talking about how inflation is actually falling. So, what is this? Okay, well, bull markets and bear markets are a sequence of highs and a sequence of lows. They're not necessarily things that go straight up or straight down. Over the past 40 years of the bond bull market, it has had ups and downs, like most assets that trade in open markets. That's why you don't necessarily timing the market is always going to be something that requires skill, that requires homework, that requires research and analysis, listening to a lot of people. But ultimately, the trend for higher rates has been set and it is in place. So the charts tell us a very interesting picture. But what about the fundamentals? Okay, why is inflation going to get stickier? Is going to remain stickier than most people are thinking? Well, one of the reasons is basically, even though the U.S. has basically maybe its economy peaked arguably in 2022, the reality is that it remains very strong. If you look at the data that had just printed during January of this year, you see that basically, job openings remain high, the quit rate remains high. There's more job openings than unemployed people. Unemployment is at a 40 or 50-year low. Labor participation is starting to tick up. The CPI is still falling, but it's still very high. And that's just in the U.S. alone. So this tells me that maybe the U.S. is not going to be, the prettiest girl in the dance hall like it was last year, but it's still gonna be up there. It's still gonna be very strong. It's still strong demand for resources across the board are gonna be coming from the U.S. as well. But it's not only the U.S., it's Europe. Europe also last year had a very complicated year. It had a big cloud of uncertainty, especially because of geopolitical tensions in Eastern Europe. Okay, but ultimately, still, if you look at the data of the past month in Europe, you see core CPI and consumer CPI reached new highs, in January, for the December reading, but the most recent reading. Okay, retail sales are stronger than expected. Unemployment at historic lows as well in the Eurozone. And even though the energy uncertainty has been a clout over European markets, I would say that after this winter, since it hasn't been as strong as it has been, and the need for energy is dissipating, I think that they're already on a trend to substituting Russian oil with other means. The U.S. of course has been a big benefactor from that. Eventually, probably Canada will be, and a lot of the Western alliances. One of the things that that was being said in a panel earlier that I was listening to is, basically, this geopolitical tension in Eastern Europe is breaking the world in two. It's basically NATO and everybody who's not NATO. And we do see a sense of tribalism again, where basically countries are going to be starting to deal with, like-minded countries, like-minded systems. You're going to see maybe even relationships like the U.S.-China relationship. Of course, that's not something that can end. It wouldn't, but it could cool down. And that in itself is going to also provide a big catalyst for prices, because there's a supply crunch, especially when it comes to resources. Now, moreover, the big inflation spike that we had last year was basically from strength out of the U.S. consumer alone. Basically the rest of the world was not as strong as the U.S. Everybody was kind of still struggling with reopening. A lot of the countries, here, Canada, like I said, it's been 3 years since I've been able to even come here, because of the restrictions and trade of people and commerce and people going and coming, etc. Emerging markets have been completely absent. And if you look at this next chart, I compare basically the price of copper, the S&P 500, and the emerging market fund, which is an ETF that is heavily weighted towards China, but it really incorporates a lot of most of the countries: India, Indonesia, Latin America, and others. And you see that actually since this is charted since 2020, March 2020, which was the bottom, the COVID-19 bottom, okay, when everything collapsed and everything bottomed. You can see that, basically the emerging market fund, all three of them were rising together. You'll see that the first vertical line that I have from 2020, when 2020 ends, you see that basically all markets, peaked at that moment. All those three markets peaked. But in 2021, something very different happened. The S&P 500 kept on rising, the price of copper kept on rising, and emerging markets starting to fall. Then at the end of 2021, we see basically the S&P already, turning the corner. EMF, collapses even further, and then copper follows both. More recently, we see a little bit of a bottom action, but we also start to see, most importantly, a little strength action from the emerging markets. And we see that even though this chart's only from 2020, if you see a chart that's farther in time from that, you'll see that emerging markets and copper historically have tended to move together. So this chart tells me that it's very likely that emerging markets this year, most of them, since they're going to be already, China especially moving away from, COVID zero policies, and a lot of other countries reopening from economic lockdowns, are basically going to make the EMF probably catch up to copper and basically resume its historical relationship. The rise in demand from EMF countries, from emerging markets, basically could put a big dent on demand globally, which is going to cause prices to surge. Of course, there's tensions in the eastern of Europe. Okay, that is also, like I was saying, that's basically fueling supply chain disruptions. That it will continue. Basically the flow of energy from situations that had already been established in the world order, okay? Basically moving away from that and trying to find new alignments, new alliances, all of that basically restricts trade to an extent. That restriction translates into higher prices, higher energy prices. So what do we do? Okay, so basically we know where we are. What do we do now? Where do we go from here? What do we invest in? Okay, and there's 5 things I'm going to tell you that you should consider. Okay, this first one is, since inflation will most likely persist for longer. Okay, and it's going to be, again, not necessarily that's going to continue to rise to an oblivion. It's probably going to come down, but it's probably going to stay above the ideal target. It's probably then going to jump back up. Okay, it's going to be trending to the upside. And one of the things that you want to be in is basically value over growth. You want companies that have solid track records, that have strong balance sheets. Companies that have a good business operation. Yes, it's very likely that their earnings are gonna be reduced by the effects of inflation and the rising cost of materials. But the reality is that it's going to be a lot better place to be than other places that are more speculative, like in growth. You see this chart is a ratio, is a comparison between industrial companies and the Nasdaq, which is heavily weighted towards tech. So basically value versus growth. And you see that this chart basically has been downtrending since 2008. This downtrend is saying that Nasdaq has been favored over the industrials over the past 15 years. Just recently in 2022 and this year, we see that chart is breaking out from that 12, 15-year downtrend. Okay, this is telling me, and it's telling us basically that the investment landscape should be favoring industrial metals or industrials, companies and metals over growth stocks like the Nasdaq, like Nasdaq companies and tech stocks. You want to make sure that you want to be heavily invested or stronger invested in these companies. Also, pick some emerging market funds. Emerging markets have catching up to do, like we were seeing. They are the ones that have not had, the bombastic year that the U.S. had last year, but they're due. Their time is due, and they have been so out of sync and so bummed out for so long. It's just time for them to catch up, and just basically recover. Not even saying that they're gonna outshine anybody, but just a recovery trade alone on emerging markets is going to be huge, and that's going to offer huge returns. If you wanna be, if you wanna have industrial, strong value, as a bedrock for your portfolios, and also if you wanna speculate with something, speculate with emerging markets. They've been bottomed out, and their downside is not as much. The downside risk is not as high as it is in other markets, like in the S&P 500 or U.S. markets. You see, for example, this next chart, I show a few different ones comparing the price action in these emerging markets, so that you can basically see and eventually choose which ones you like the best. But ones that I've been following that I like a lot are basically the emerging markets that are picking up where China is leaving off. Okay, in this new alignment that is shaping, new alliances that are shaping, we're seeing basically the U.S. companies starting to set up another operation somewhere else. They don't want to just be completely exposed to China and to China's policy and crackdowns and breakdowns and everything that the government has been doing. They want to be able to operate without being affected by that political risk. So it's very likely you're going to see like a lot of companies move their investment, their production powerhouses, to places like India, Indonesia, Mexico, Brazil, Latin America, back to these countries where, they have stronger alliances, they have basically a stronger relationship, that have more like-mindedness, more tourism between them, more of a relationship, stronger relationship that eventually would not be a threat to U.S. interests, like China has become. Then, of course, invest in gold. This would have been my number one, but I know that you guys have heard this from everybody in this conference, or most likely. But you want to invest in gold. This chart is basically the secular bull market in gold that started early 2000s. I love this chart because look at that blue line, that beautiful blue line. And more importantly, look at the more recent decline, how it actually held right at the blue line. And now it basically is bouncing up and is breaking above the red line. That red line is a 23-month moving average that we've identified over the years as a moving average that really, really captures the longer-term moves in gold. Okay, so you see, for example, like back in the 2000s, how gold broke above the 23-month MA and held at it until the 2011-2012 peak. Then it broke below it into that bear market that most of you or a lot of you might remember, that bottomed in 2015, December 2015. And then it started to basically go up until a new high was reached in 2020 and has stayed persistently strong still. Of course, gold tends to rise in inflationary environments. And even though a lot of people were kind of upset with gold's performance last year with such a strong inflationary situation, actually, gold did what it's supposed to do. The thing is that it rose stronger in the 2020, 2021. It consolidated in 2022. But really, it ended the year without losing anything compared to the S&P 500 or the Nasdaq that lost, double digits for the year. So actually, gold held its own. Maybe not as strong as the dollar. The dollar stayed stronger for a lot of other reasons. Okay, but still, those two, the dollar and gold, were the strongest currencies last year. Of course, the gold miners. You don't want to forget about the gold miners. They're also this longer-term chart. You can see that since 2008, the January 2019, the rise has been spectacular, and the miners are breaking out again from a very strong downtrend. Again telling us that maybe it's reversing, and now we're going to start seeing more upside for the miners. The chart below is a leading indicator, a momentum indicator, and the reason why I show it is because of timing. Again, we're talking about what are the current trends that are shaping, but nobody's talking about timing. Do I buy gold today? Do I buy gold in a month from now? When do I buy gold? Okay, this chart is telling me that we're probably going to see over the next few months a pullback in gold. Gold has risen 20% from the November lows, almost 20% from the November lows, and it's very likely that it's going to pull back. This pullback, could break below $1,800, and if it does, it's going to be an amazing time to buy gold, to buy the miners, to buy silver, precious metals. So I wouldn't necessarily go out if you haven't invested in gold, or if you're still looking to get into gold. I wouldn't necessarily go and dive into it right now. wait a little bit for the next 3 to 6 months for the right time. Gold will pull back, and so will the miners, and they will provide a great time to buy if you're not in them already. If you're in them already, you might want to actually take some profits off the table. Maybe, not sell everything completely, but, trim your positions, increase your cash position so that you can actually take advantage of the lower values over the next 3 to 6 months. Because the reality is that gold will likely bottom over the next 3 to 6 months in a mild decline that is technically we call a B decline, very normal. But what's even better is that what follows that B decline is a C rise, which is going to be a very, very strong moment for gold. It's going to be maybe like a reconfirmation of the secular bull market. We're likely going to see gold rise to new highs and even higher. The target on the upside is around 3,000, and over the next for the next 2 years, from here to 2026, that is really not crazy at all. Of course, silver. You can't forget silver. And instead of just showing you a normal price chart of silver, showing like how it goes, up from left to right, this is basically a gold to silver ratio. This compares gold to silver. It tells you how many ounces of silver you need to buy 1 ounce of gold. And this is important because the relationship between them, over time fluctuates. And that's maybe because there's more risk sentiment, or there's more safe haven sentiment, and depends on what is driving the market at the moment. One will be preferred versus the other. In bull markets, like the one that we've confirmed for gold, silver tends to outperform. Same with the miners. So yes, you want to have gold, but you also want to have silver. You also want to have the miners, because that's where you're gonna get your alpha. You want to build exposure to industrial resources. Okay, so also inflation means prices of things go up. Okay, and that is terrible for a lot of companies that their cost of operation goes up, and they have to basically, and their profits squeeze to the downside, and probably valuations. But you want to build exposure to resources as well: copper, uranium, natural gas, energies as well. And this is my last chart, and I'll end with this. But basically, also, don't be too eager to get rid of U.S. dollars. I mean, everybody is loving to hate the dollar always, and I think last year the rise to a peak in dollars, proved a lot of people wrong. And like the reason is many reasons, but one of the reasons that never really gets talked about is how the dollar is also a payment system. You can send dollars from here to anywhere in the world. It doesn't have to bypass directly the U.S. And that is a facility that no other currency really has. Unless there are bilateral agreements between countries. So that in itself allows for things to flow. The dollar will likely remain strong. It has pulled back a lot. And the reason I show the momentum indicator here as well is because, as you can see, the indicator is at an extreme low, telling us that the downside for the dollar is maybe overexhausted already. Okay, and you see that red line on the dollar at 40-month MA has also captured the long-term moves on the dollar pretty well. That's 97.50. That means that the U.S. dollar index could still fall to 97.50 and remain bullish. Okay, so don't be too fast to discard the dollar just yet. You want to keep some of the dollars in your portfolio because it's very likely we're going to see a bounce up short term. So with that, I leave you. I overstayed my stay for a little bit, so I'm sorry. If anybody has any questions, I'm going to be here the rest of the afternoon. I would love to talk to you. I'm here, for that. So thanks again for joining my presentation.